It's safe to say the markets are caught between optimism and uncertainty this week, with central banks, trade talks and tech earnings all sending very mixed signals. Let's head to Sydney. We're joined by Steve Gopperland from Skander FX. Let's start, I guess, with a market overview. We've seen a pretty cautious tone right across those global markets this week.
Good morning, Aaron. Thanks for having me. Yeah, quite exciting times in the market as we speak right now. This week we saw plenty of action, especially from all sort of central banks. We heard from the Fed, we saw from ECB, Bank of Canada, we had our local inflation data as well. You can make what of it, but instead there's plenty of volatility in the markets, and it's got traders on the hook as well.
Let's talk about what's happening with the Fed, because that was, I guess, we got a bit more of an understanding about where they're sitting, where Jerome Powell is viewing things, and the fact that inflation is still such a massive concern, isn't it?
Yeah, 100%. I mean, you're spot on. Inflation is a massive concern for the Fed. But in saying that, also, you have to understand the Fed is acting without access to proper data, right? So this particular Fed meeting was quite interesting. Good to see, majority of the voters preferred a rate cut. But in saying that, we saw two dissenters, and obviously one of them was Steve Moran, who voted for a 50 basis point cut, and the other person who preferred not a cut was the Kansas Fed chief, right? But overall, the tone or the language was what caught traders by surprise. Jerome Powell was super clear that even though October was good, it doesn't look like we've got a clear cut happening in December. So that rate cut that traders are betting on December doesn't look like it's a sure shot for now.
And how much do you see, I guess, conflicting signals from central banks at the moment when it comes to influencing trader sentiment at the moment?
I think it's the other way around. The trader sentiment is they're just front running most of the central bank announcements at this stage. What they're trying to see is that, hey, to probably take a bet or a position in the view that they're correct. In terms of the central bank itself, obviously inflation and unemployment is the dual mandate that the Fed holds. And at this stage, they're seeing signs of a cooling labor market. So inflation is seen as pass through, but this all could change if they say things don't work out as planned between US and China.
Now let's talk about the tech earnings. It's been a really interesting week. We've seen Nvidia and Alphabet with unbelievable results, but questions for companies like Meta still about that AI spend?
Yeah, I think that the Meta earnings report caught most analysts by surprise. They didn't expect a huge sort of expenditure happening on AI. What they are also concerned about is, when do we see the results of all the spend that we're seeing from these, on these AI and all the stuff. But interesting to note that Nvidia, it's almost a $5 trillion cap company, and it's just a monster. It keeps growing. In the best part of where they are placed right now is that, even though they're deeply involved in the AI space, they're the ones providing all the infrastructure. So as long as AI continues to boom, I think Nvidia keeps rallying higher and higher from here.
Obviously, Treasury yields are steady and the dollar is staying firm. Do you see this as, I guess, a calm time before the next wave of volatility?
Aaron, you tell me when the next wave of volatility kicks in. It could happen even as we speak right now if Trump decides to go and tweet that he's unhappy with the outcome of his meeting with President Xi. So, look, I mean, in terms of where volatility sits, traders are very mindful that this all could change. I'm not sure if you spoke to many guests regarding yesterday's meeting between President Trump and President Xi. Look, to me, it looked more of a handshake and an informal catch-up than a formal, legally binding agreement. So, plenty to talk about over there as well. So, I think that's going to be one of the main concerns for volatility as we head into end of this year.
Yes, President Trump came out with a scale of 0 to 10, a 12, he said, and yet no one can actually see any detail as to what's happened. He went in trying to get a deal over TikTok. There was fentanyl, which I believe has come down to 10%, and there's pretty much a delay in those mineral deals over the next year. But in terms of, I can't see the 12. What do you see as a 12 out of 10?
Yeah, that's a classic. That's a classic President Trump quote over there. I mean, From what we can see from the what the meeting looks on the outside, it's interesting to note that the obviously China's agreed to relax on the rare earth exports. They've also agreed to purchase soybeans and other grains. They've also said that they're going to come, on the fentanyl exports as well. They're going to curb on that as well. So that looks promising. So you can definitely say that's a win for US and for President Trump. What it really doesn't come into full play is that there's nothing actually that's legally signed. They probably can go on their words. There was no mention of AI or Nvidia for that matter. I think most traders or market participants were kind of looking for clues whether there's going to be chat about that. And the other thing was also Taiwan. I think, Taiwan being such a sensitive issue, they thought this would be a great time where, that dialogue would be coming to table as well. So it looks like some key part of the message is still missing. And from what all I can make of this is that, look, yeah, it's good. They've, as I said at the start of this chat, it looks like more like a handshake than a formal treaty. So let's just see what happens in a year's time. Well, we go back to the drawing board and things change.
Well, it's not as if markets were overly optimistic the way they ended the day. How much confidence do you think markets can place in a deal like this, which, as you say, feels a bit more like a handshake agreement?
I mean, for last 24 to 48 hours for most traders, I'm sure they're probably tired of all the messaging that they heard from the Fed. And, I actually thought the Fed was probably the one that most people are going to probably actively participate on. It was a very muted reaction. So looking into the outcome of this meeting, there was nothing more to read into it. It just felt like another day's catch up for Trump, President Trump. So I would say that's probably why the traders were not much fazed by it. But in saying that, let's watch what happens in the next coming days.
All right, let's talk about Australia and the RBA at the moment, because this is a really difficult task now. A lot of people are pointing the finger at Jim Chalmers and the pressure that he put on the RBA to cut rates this year. They cut rates, and guess what? Inflation's gone back up. But now, so is unemployment.
Yes, I mean, I don't feel any sort of luck sitting on this side of the spectrum. If I'm a person looking to buy a house in Sydney, I mean, the property value has just gone up through the roof, right? Obviously, again, I'm not sure if that's one of the reasons why RBA's inflation gauge has gone up as well. But overall, from what we can make out of this, that inflation reading is really coming hotter than expected. It's beyond the central bank's preferred gauge, the preferred measure for inflation. So at this stage, the hopes of a rate cut, which everyone was expecting at least slightly before end of this year, is all pushed back to probably May 2026. I read a note from NAB the other day. NAB's saying that this potentially could also be a pivot from the RBA, where we might actually not see a rate cut at all. This could be the bottom of the market as well for interest rate markets. Again, data dependent. I mean, just because we've had one data, that doesn't mean that RBA is going to change their mind or put everything in stone. The next unemployment data, if that comes in, and if it's something, that number that is within line expectations, we never know. The RBA might change its tune. But for now, it does look like the interest rate part for Australia looks like it's probably either on stall, or we're looking next move will be higher.
It's a mess. If you are sitting on the board of the RBA or in the Treasury Department, I mean, let's have some facts here. 9 consecutive quarters of per capita GDP decline. Then you've got inflation has gone up to 3.5%. That is big. Unemployment numbers are going up. Power prices have had a massive increase in 1 month alone. And then we're being told that power will continue to go up, obviously, as the push towards net zero carries on. Businesses are closing. Which number does the RBA look at?
Obviously, their preferred would be the TRIM CPI quarter on quarter. That'll be their focus on. Once again, Aaron, from compared to the rest of the world, you got to understand that the rest of the world is also pretty much in a similar boat as we are. I mean, in fact, we're much better than compared to the rest of the world. The other day we've sort of heard from Bank of Canada. They said that their projections for next year's growth is sitting at 1%. So compared to that, Australia is doing really good. So, yeah, I know it's not it's not apples to apples, but in saying that, sometimes we got to look at the bigger picture over here as well. We're not doing as bad as the rest of the world is.
Yeah. All right, Steve Goplan, appreciate your time. As always, we'll talk to you again soon.
Thank you.